So last time we were on the types of consideration. So we are saying that since we are going to be looking at the issue of acquisition method, okay, we are going to be looking at a situation where one entity will be paying for the equity share of the other one. So we are looking at how this can be what the forms that this can be done, or the acquisition. Okay, if you want to purchase, what are the means that you can use? And we spoke about the so we have the types of consideration. Okay, so we spoke about the types of consideration. Okay, and we spoke about a cash consideration. So we are saying that they can pay cash. Okay, they can pay cash. You just pay cash. If it is 20,000, you just give the person 20,000 cash. Yeah. How do you record this? Okay, the parent will be having investments, and that will be in the what the equity share, the former equity shareholders will not be there again. So nothing will be affecting the equity shares. So they will just be paying this money to what? To the existing equity shareholders. The subsidiary is not issuing new shares to the what? To the parent. The parent is buying from the existing shareholders. So no adjustment will be made to the what? To the subsidiary shares, but just that they are going to be receiving the cash, but they will using the cash to pay what? To pay the existing shareholders. So there will not be anything over there. But the parent will be having this particular one as what we call investment, or investment in subsidiary, or whatever investment. The question will give you how this has been recorded. Okay. And we also look at what we call the deferred consideration. So the deferred consideration, we are saying that, okay, we are going to give you cash, all right, but we don't have the cash to give you immediate cash. So we give you the cash, or we pay you maybe in 2 years' time, in a year time, or in 3 years' time. It depends on what the question is saying. And we are saying that whenever this happens, we have to look at the present value that, or the today's value that the parent will be paying for what? Paying for this particular amount. Because if you have cash to pay today, you are not going to be paying the same amount that you are going to be paying in the future time. So what will happen is that we are going to be looking at this one to, okay, this is actually what? A deferred consideration. So we use this example to demonstrate how we account for what? Deferred consideration. Okay, so okay, I hope you can see my screen. The example, some of the examples on the screen. Okay. I
Yes, we
hope
can.
okay, okay. So we are going to use the third point. That is a deferred consideration, to demonstrate how we go about a deferred consideration. Okay, these are the things that I want the corporate reporting people to know. Financial reporting, we are going to be solving our questions on Saturday. Okay, so let's come here. They said that FDUC acquired 600 million equity shares in Kumau on 1st April 2016. The purchase consideration was made up of what? They have a share exchange, they have a loan note. We'll go there soon. Okay, a deferred cash payment of what? 11 pesos per share acquired, payable on 1st April 2017. Okay, the acquisition is done on 1st April 2016, but they are going to be paying on 1st April 2017. Okay, the payment will be done a year from now, isn't it?
Yes, it is.
Okay, but they are paying 11 pesos per share, isn't it?
Yes, please.
How many shares were acquired?
600.
Okay, so how 600 million? How much will be paid? How much will be paid in a year time? How much will be paid on that particular date? Okay, so let's look at this one. Let's look at the future value, which is the amount to be paid on 1st April 2017. Okay, so that will give us 11 pesos multiplied by the number of shares acquired, because they are saying that they are going to be paying 11 pesos per what? Per share. So for every share that we have acquired, we are going to be paying 11 pesos for that particular one on 1st April 2017. Okay. So what are we getting as the amount that we paid on that particular date?
That's 66 million.
Okay, 66 million. Okay, 66 million. Okay, this 66 million, assuming we have cash to pay today, will it be 66 million?
No, sir.
Okay,
No.
so we assume that the person has taken into consideration, the shareholders of the subsidiary has taken into consideration time value of money. So the money that you are going to be giving to them today, if you give them today, if they invest it at a particular interest rate, they are going to be getting an interest of that amount. But since you are keeping that amount, you have to pay them the amount plus the interest that they would have earned on that particular transaction. Okay, so the deferred consideration, we normally present value this one. So we present value this, taking into consideration the cost of capital of the parents, unless the question is not giving you the cost of capital of the parents. Okay, the value of each share of this one, okay, and a FDUC has a cost of capital of 10% per annum. Okay, so this is a future value. We want to find a present value. So we have, someone can do 1 over 1.1. We are paying this in a year time, so the exponent will be 1, isn't it?
That's it.
Multiplied by 66 million. What are we having?
60 million.
Okay. So our our consideration today is what? 60 million. The question will tell you that this part of it this part of the transaction or this part of the consideration has not been recognized. So what will happen is that if you want to do this, you go and debit the investment in subsidiary. Okay, the parent will be having investment, which will be 60 million. Okay, you are owing the people 60 million. So what will happen? You have a liability, isn't it? Okay,
Yes.
but this will be paid in a year time. Okay, so what you do over here is that you are going to be crediting deferred consideration, which will be a liability, and that will be a current liability. So you have 60 million. Okay, let's come here. At the end of the year, what are you going to be doing? Okay, at the end of the year, you can see that you can actually charge an interest of what? 10% on that particular figure now, because we have done a year, we have to pay the interest to the people. So what will happen is that you have to calculate a finance cost. Okay, you have to calculate a finance cost on this because you are paying the people 66 million, but the financing component, this particular 66 million is having a financing component and a principal component. So we have separated the principal component of 60 million from the what? From the financing component. So at the end of the year, you pay interest of 6 million, which is the what? Which will make it 66 million. So you calculate that interest as 0.1 multiplied by 60 million, and you'll be having 6 million. Okay. The parent will be paying interest on the deferred consideration of 6 million. Okay. Finance cost is what? It's an expense, isn't it?
Yes, please.
Okay. So if you are doing profit or loss, you take the finance cost of 6 million to profit or loss. Okay. But if you are doing statement of financial position, this would have been charged against profit. But since we are not doing statement of profit or loss, we know that the profit for the year will be included in the retained earnings of what? Of the parents. Is the parent that is giving them this deferred consideration. So we know that the profit for the year, we should have taken the finance cost against it. This has not been taken into the books. The question will tell you that the parent has not recognized this side of the purchase consideration. But if they say it has been recognized, then it means that you don't have to do anything because they have what they should do. But because they are going to be giving you this information that you can adjust it, they will tell you that this has not been what? Recognized. So you are coming to do what should have been done. Okay. So you are coming to do what should have been done. And this is what should have been done by the what? By the accountant of the parents. So if you are doing statement of financial position where you are not going to be giving profit for the year, which the finance cost should have been written against the profit, you know that profit at the end of the year will be added to what? to the retained earnings at the beginning so that we have the closing balance at the what? At the beginning. So the profit for the year is included in the closing retained earnings of the parents. Okay. But the profit should have been reduced by 6 million. But since you haven't done that, you go to the group retained earnings now. So you debit group retained earnings, which of them that you are doing. If it is statement of profit or loss, you debit retained earnings, group retained earnings of that particular 6 million. Okay. This particular 6 million should have paid to people as interest, but you haven't paid it. So that will still be what? That will still be a liability. So what you do is that you just go and add it to your deferred consideration. You just go and add it to your deferred consideration of 60 million to have 66 million, which you can pay to the people at the end of the year. Okay. So when you have deferred consideration, this is the issue about it. It can be in 2 years' time, it can be in 3 years' time, it can be in 4 years' time. What you have to know is that if the people you have cash and pay now, they will not pay the amount that they are paying at a future date. So it means that they have factored in time value of money. So how much should have been paid for the shares? How much are we paying for the shares? The amount that we are paying for the shares is the present value of the future payments. The remaining one, the difference between today's value and the future value is the interest that will be earned or that will be accrued over the over the payment period. Okay. And that's how we go about it. So this is basically about the deferred consideration. Okay. Let's come to the next one. Okay. Apart from we saying that we don't have cash now and we are going to pay you at a future date, what again? Okay. Let's come to the next one. What again? What would be the other forms of settling the consideration? Forms of consideration. So, okay. We have what we call a contingent what? Consideration. Okay. A contingent consideration. Okay. About a contingent consideration, it's not that we don't have cash. Okay, we have cash, but we are only going to be paying you or we are only going to be paying you on a condition. Okay, so what will happen is that it's not that the parent does not have cash. Okay, they have cash, but they are saying that they are going to be paying you this amount based on a condition. What will be the condition? They can say that they are going to pay you this amount in 2 years' time when you are able to increase your profit by 25%. So the payment depends on a condition or a target that is being given to the parent that is being given to the subsidiary. So it's not that the parent does not have cash, they have cash. But what will happen is that they will only pay you this amount or they will only pay you the consideration if you are able to meet a particular target. The target can be a sales target, it can be a profit target, and whatever is going to be the case. Okay. If you come to the issue of contingent consideration too, if you are saying, if they are telling you that they are going to be paying 200 million at the end of the 2 years, if the profit increases by 25% or not, if you are not giving the fair value of this particular consideration at the acquisition date, okay, you also use the issue of the present value. Okay, so 200 million today cannot be 200 million. The value of 200 million today cannot be the value of the same 200 million in the future. So it means that they have a value over here, which they have also taken into consideration time value of money. But the interesting part is that if they give you a contingent consideration, they will give you the fair value at that particular date. Okay, they will give you a fair value at that particular date. But if you are not giving the fair value at that particular date, but you are giving only the future value, the value that they are going to be paying in the future, please, we apply the principle of time value of money over there too. The present value is, and the remaining will be the financing component, which you amortize or which you accrued over the 2 years. But whatever be the case, they will always give you, or they might, okay, for the questions that they have been setting right now, they have always been giving the fair value of this particular consideration at acquisition date. Okay, so we are saying that we are going to be paying you. So the question can say that the fair value of this particular consideration is, let's say, 150 million at acquisition. Okay, So let's assume the question is telling you that this has not been recognized. If they say this has been recognized, please don't go and do anything because they have done all the things that they're supposed to do. So all the entries that should have passed for this particular transaction has already been entered in the books. You only do certain adjustments when the question says that this has not been infiltrated or this has not been recognized in the books of this company or that company. Okay, so we are saying that this has not been recognized. Okay, whatever we are doing, this amount, we are going to be paying it for what? For the shares that we are buying. Okay, but we haven't given this amount to the people yet. It means that we have purchased the shares on credit. We have purchased the shares on credit. Okay, so if you have purchased the shares on credit, it means that they are going to give you the shares while you are going to be owing them. So what we do is that we are going to be debiting the investment, which the investment will always be gross out to have what we call a purchase consideration. Okay, we are not paying these people, so we are going to be owing them. Okay, depending on how long it will take the shareholders of the parent or the investor to pay these people, it can either be classified as a current liability or non-current liability, depending on the duration. Okay, so we are going to be crediting contingent consideration, which will be a liability. It can be non-current or current, depending on the duration. Okay, okay. What will happen is that since this has been since this amount will be paid at a future date, okay, what will happen is that at the end of every year we have to be what? We have to be increasing it, or we have to be what? We have to be unwinding it. Okay, so they will give you are owing the person 150. They can give you a value at the reporting date. Okay, they can tell you the fair value of this at a reporting date is now 170. What is happening here? You are owing them 150 at the beginning of the year. At the reporting date, you take the total amount that you are owing them now is 170. What is happening there?
There's a finance cost,
Okay, there's an increase of what?
20 million.
Okay, this is a liability. If liability is increasing, is it a gain to the company or a loss?
It's a loss.
Okay, so what you do over here is that the treatment, the subsequent treatment, which will be at the reporting date, okay, if there's any increase or decrease, it will either be a fair value gain or fair value loss. Okay, please don't say finance cost because we are not present valuing. They are just giving us a value to us. But if we are doing the present value, that's what we call it, the finance cost. Okay, but they are giving us a value. So what will happen is that we will just say fair value gain or loss. Okay, so there is a fair value loss over here. There's a fair value loss of 170 minus 150, and we are having 20 million. Okay, so you are owing somebody now. The amount has increased to what? 170. So the 20 million now is what? Is a loss to you. You have to pay additional cost. Okay, that is a loss to you. That's an expense to you. So what we do is that if you are doing statement of profit or loss, we are going to be taking fair value loss to either administrative or either other expenses or whatever they are. They will tell you how it should be classified. But if you are doing statement of financial position, it is the parent that is going to be paying this amount. So this will be a loss to the parent. So we debit the group retained earnings. We debit the group retained earnings of the parents, which will be the closing one. They should have been taken from their profits. But we don't have the profit. But we know the profit is included in the group retained earnings. The profit for the parent is included in their closing retained earnings because the closing retained earnings is obtained as opening retained earnings plus the profit for the year. So the profit is included over there. So let's go and subtract our loss. Let's go and subtract our loss from it. Then what will happen is that you have to increase because in the books you are going to be having 150. Now it is 170. So you have to increase it to have your 170 now. So we have credit the contingent consideration with what? With 20. So you go to your statement of financial position and add wherever you are having the purchase, you are having a contingent consideration, you add 20 to it to now make it what? 170. If it is the opposite, it will be a gain, and that gain should be taken to profit or loss. But if we are not doing profit or loss, then we have to take it to the group retained earnings. So if this should be reducing, that is a gain to the parents. So the opposite is what is correct. So if it is a gain, it means that contingent consideration will be reducing. Okay, it will be reducing, and in that case, the parents will be what? Will be crediting their group return earnings or their return earnings because it's a gain. And contingent consideration will be reducing and we'll be debiting that particular one. Okay. So we can also have what we call a share exchange. Okay. It's a very important one. The share exchange, mostly the problem is over here. Okay. We will try to see what we can do. Okay. Okay. We are saying that we don't have cash. Okay. We don't have cash. But what we are going to be doing is that, okay, we are going to be giving you shares. Okay. So we are buying, let's say we are buying 600, or let's say we are buying 60 million of the what? Of the equity shares of the investee. And we are saying that we don't have cash to pay you now. But what we are going to be doing is that we are going to be giving you shares. We are going to be issuing shares to you. Okay, we are going to be issuing shares to you to what? To buy the what? We don't have cash. Okay, we don't have cash. So what we are going to be doing is that just like you want to buy something and you don't have cash, you can actually what? You can actually give something in return for that particular one. So it's just like what? A barter trade. We are giving you the shares and we are having your shares. Okay, so we don't have cash now, but we can issue equity shares. This particular share exchange, they can be like they will give them equity shares or they will give them preference shares, any of them. So they can give them preference shares also. But this one mostly we assume that is that they are doing what? Share exchange. So we are giving you our equity shares for what? For whatever you are buying. Okay. It's just like you want to buy plants, but you don't have money. So you want to use your shares to pay. Okay, you want to use your shares to pay. So what will happen is that if you are buying plants, okay, if you are buying an asset, if you are buying an asset, that costs what? 20 million. Okay, you should have paid cash for this particular one, or you should have even bought it on credit, but you want to pay with what? You want to pay in kind. Pay in kind means that you want to pay with something other than what? Cash. So what will happen is that we are saying that, okay, we are going to be issuing shares to you. That will be what? That will be 20 million. Okay, so you are going to be giving them shares, equity shares, that will be valued at 20 million. Okay. Okay. Assuming our equity shares is 100 million before we have issued the new shares to settle the what? The payment for the plant. What will be our total shares now? What will be the value of our total? What will be our value of our equity shares after we have used the equity to pay, after we have used the shares to pay the plant, to pay for the plant?
120.
That will be 120, isn't it? Okay. Please don't go there and be saying that the entity is going to be using its existing shares. No, we are not using the 100 million shares to what? To pay for the plant. No. The existing shareholders will still be the existing shareholder for the company. And we are having a new what? A new shareholder. What it means is that the entity can either issue this for cash. Okay. The entity can either issue this for cash. So we don't have cash, but we need cash. So what we do is that we are going to be issuing our equity shares for 20 million for people to buy. So if they buy, then we use the money to pay for what? To pay for the item now. So we can say that the entity is going to be issuing shares that will be valued at 20 million. And they will receive cash. After receiving the cash, then they will use the cash to pay for the plant. It doesn't mean that the existing shareholders, 20 million of the existing shareholders will not be there. No, the existing shareholders will still be there. If it is 200 million shares that they have, they will still have the 200 million shares and they will be issuing additional shares in return. So the shares will be increasing. The mistake that most of the students they make is that they think that the company is using its existing shares to pay for. No, none of the old or none of the existing shares or the old shares of the parent will be leaving. They will still be there, but the parent is issuing additional shares to what? To purchase the what? The shares that they want to acquire. They are issuing additional equity shares to pay for what? The shares that they are acquiring in the what? In the investee. In principle, it's just that the parents will issue equity shares to the value of 20 million. If they issue the equity shares to the value of the 20 million, this is what will happen. They will receive cash. So they will debit their cash with 20 million. and they will credit their what? Their equity, because equity is now what? Increasing, and the shares is also, the cash is also increasing. Okay. We are not issuing the equity shares just for equity shares. We are issuing the shares to pay for the plant. So you see that the cash that we have received over here would have been, will now be used to pay for the plant. So what we do is that we debit our assets now, which is the plant, with 20 million. Then we credit our cash now. Okay. We credit our cash now. So what it means is that we can say that cash is having a zero effect. So whenever there is a share exchange, the issue will be between the assets. So we debit the assets, which is what? 20 million. Then we credit what? Equity of 20 million. Okay. Can you see this as, can you see this is the what? This is the net result from what we have just done over here. You see that the cash will be having a zero effect. We are debiting the cash and we are crediting the same cash. So the cash will be having zero effect. So there's no need for us to pass entry for the what? For the cash. Okay. So if there is what? If there's a share exchange, the parent is issuing new shares to pay for additional shares, to pay for what? The shares or the equity shareholders of what? Of the subsidiary. So what it means is that the parent will be having an asset. What is the asset? We are making an investment in what? In the subsidiary. So that will be our investment. So you debit our investment, which will now be grossed up to have our purchase consideration. Then our equity shares will be increasing. But the question is, they will not give you this particular thing. They will not give you the 20 million as the value. Okay. They will give you how the exchange will be done. They will give you the exchange ratio. Okay. So sometimes they can give you 2:3, 2:5, or 1:5, 1:2, whatever they are going to be saying. Okay. So they can say that this will be 2:5. Okay. The 2:5 means that the existing shareholders of the subsidiary will bring 5 of their existing shares that they own now for what? 2 new shares in the what? In the parent. Okay. What it means is that they are going to be bringing, or the parent is going to be paying them for only 40% of their what? Their shares. The parent will pay only for the 40% of the shares that what? They have purchased. How do we get a 40%? That will be 2/5 multiplied by 100. And that we are having 40%. So you can just find 40% of the shares that the parent is buying in the what? In the subsidiary. That will be the number. The parent will give only 40% of the shares. Why would this be possible? The price of the parent shares will be higher than that of what? That of the subsidiary. So if the parent shares are trading at what? Let's see, if the parent shares are trading at 10 cedis and the subsidiary shares are trading at what? Trading at 2 cedis. Okay, there is no way I'll give you the same value of shares that is cost 10 cedi to for shares that are cost what? 2 cedis. No. So you can see that 5 times my share is what? Is one of your own. So this particular ratio can be 1:5. Okay. So they can also give you the price of the shares. You can also use the price of the shares to determine what? The exchange ratio, because the shares of the parent are trading at 10 cedis. Your own is trading at 2 cedis. There's no way I can give you the same number of shares that are trading. My shares are trading at 10 cedis, and I'll give you 10 cedis. I'll give you 20 million of my shares for 20 million of your shares. No, it doesn't work like that. The share prices are different. So what will happen is that the value of the shares that we're giving to you have to be equivalent to what? The value of your shares. So if you are giving me, if I'm buying 20 million shares from you, which will be giving me, if I multiply it by 2, will be giving me 40,000 shares. I have to give you only 4,000 shares. Okay, you will be bringing what? You'll be bringing 20,000 shares, but I will give you only 4,000 shares. Why? Because a share is what is valued at 10 cedi for me. So if I'm giving you 20,000, it means that I'll be giving you something like 2 million, no, or 200,000. What will happen is I have to give you a number of shares that, if I multiply it by my share price, will give you the same value of the shares I'm buying from you. So that is why the exchange ratio will not be 1:1. Okay, except the shares are of the same value. Okay, if it is of the same value, I can say 1:1, but it will always be 1:2 or 1:3. And that 1:2, 1:3 means that the subsidiary, the shareholders of the subsidiary will bring 3 of their shares acquired for 1 share in what? In the parent. Okay, so how do we do this? How do we determine the number of shares that will be given? Okay, I've given you 2/5. So 2/5 means that we are only going to be giving 40% of that. Okay, so we have 2/5 multiplied by the number of shares that the parent is what? Is acquiring. But what will happen is that we want to determine the value in terms of Ghana cedis. We are not looking for the number of shares. So we find the 2/5 multiplied by the number of shares. Then these shares, it is the parent that is giving its shares out. So the parent will now what? Value these at what? At its share price. Okay, let's look at example there. I'm sure I have example with that particular one. Okay, so let's take that particular example here, and I will explain so that you get a share exchange and you know how to go about it. Okay, FEDUC acquired 6 million equity shares in Kumao on 1st April 2016. The purchase consideration was made up of what? A share exchange of 1 share in FEDUC for 2 shares in Kumao. Okay. So what is the exchange ratio here?
1 for 2.
Okay. So they are bringing 2 of their shares and they are taking 1, isn't it?
Yes,
Okay.
please.
It means that they are going to be paying for only 50% of the shares, isn't it?
Yes,
Yes.
please.
Okay. So look at this also from this perspective. Okay. The shares are quite. Okay, the shares are quite. It's 600 million shares, isn't it? Okay. Okay. The parent, if the parent want to what? If the parent want to finance this particular one, we can say that the parent is doing a right issue of 1/2, isn't it? If they want to
Exactly.
acquire this one, if they want to finance it, they are doing a share exchange of 1/2. What it means is that they are going to be doing 1/2 of these shares. So the parent will issue 1/2 multiplied by the shares that they are issuing. They are what? So the parent is doing 1/2. It means that we are going to be issuing 300 shares to finance this particular purchase. So that will give the parent 3 million shares, isn't it? Okay.
Yes, please.
These shares will be issued at what? If the parent wants to sell the shares to the outsiders to raise money and pay, the shares will be issued at the what? The market price of the parent shares. So the parent will issue 300 shares at a value of 0.75. What are we having? Would that be 225?
5. Yes.
Okay.
Yes, please.
225. Okay. If the parent is issuing these shares to the what? To the outsiders, what will be the entries that the parent will be making if they receive cash?
They will debit cash and then credit it.
Okay, so they will debit cash with the same amount, credit what?
Equity.
Equity. But what are we issuing the shares for? We are issuing it to pay for what? The shares that we are buying, isn't it?
Yes.
Okay, so it means that immediately after we receive the cash will now be used to pay for the shares that we are buying from what? From the shareholders of what?
The
Of the
shares.
subsidiary. So we now be having, the parent will now be having, so the parent will now be debiting the investment, which is an asset, at 225. Then cash will now be credited, isn't it?
Yes, please.
Okay. Looking at this, what is the net effect over here? You can see that the cash is going to be having a 0 effect. We are debiting the same cash with the same amount, and we are crediting, isn't it?
Yes, please.
Okay. So what is the net effect from this? It will be debit investment and credit what?
And credit equity.
Equity.
Okay. So the question will tell you that this portion of it has not been recognized. So this is what you do. So you look for the shares value. So you look for the shares value, which you are going to be calling the purchase consideration, because that is what you are paying. So this will be calculated as 1/2. Okay, if they say 2/5, it is 2/5. Or you can say 20%, or you can just say 1/2 is 50%. So they are only paying 50% for the shares. Okay, they are only going to be giving them 50% of their existing shares. That will be 300 million. So you multiply this by 600 million. This will give a number of shares, but we are looking for the amount that we should have paid them. So this will be valued at the parent what share price. So we'll be having 225 million. Okay. If this has not been recorded yet, what you do is that you debit your investment, which we call the purchase consideration, or some will call it cost of investment, depending on who taught you business combination. Okay. Then we credit what?
Equity.
Equity. Please, we are not using what? We are not using existing shares. No. The former shareholders of the parent will still be there. Okay, they will still be the owners of that one. Then we are having additional owners. So our share value is increasing. Okay. You can also have an issue of share premium, but in the exam condition, we don't pay attention to that. Why do we say we can have a share premium? The question can tell you that the equity shares of the parent are currently valued at 50 pesos. Okay, so if they are currently valued at 50 pesos, it means that the value that will be going to the equity shares should be only 50 pesos, should be the value of 50 pesos. And that will be 50 pesos multiplied by 300. And that will give us 150. Okay, so it means that the shares should have been issued at 50, but we are issuing at 75. We are issuing more than that one, which will give us a share premium. We should have been having the equity of 150 and the share premium of what? Of 25. But please, they don't pay attention to this. So just take all the share exchange to equity value. Okay. Just take all the share exchange, which is 225 to what? To the equity value. That is fine. Okay. Sometimes, okay, so the entry will be if they say this has not been recognized, you just go and increase your equity with the value, and you also increase your purchase consideration with this value. What do I want to say? Sometimes we can have issuing cost. Okay, we can have related what? We can have related acquisition cost. The related acquisition cost, I'll be talking about owing what? Owing the issuing cost. Okay, owing the issuing cost. Okay, which we call the transaction cost under financial instruments. Okay, so sometimes the question will tell you that during the share exchange, the parent has incurred what? An issuing cost of, let's say, 2 million. Okay, the parent has incurred issuing cost of what? Of 2 million. How do we treat issuing cost under financial instrument? It's capitalized, isn't it?
Yes.
Okay, so we have issuing cost. The issuing cost will be the cost incurred by the parent of issuing its own security. So the parent cost, the issuing cost incurred by the parents in issuing its own security. Okay, if they are saying that during the share exchange, they have issued the shares and they have incurred a cost of what? A cost of 2 million. Okay, this cost will not be expense. Okay, it's a transaction cost which should be amortized over the useful life of what? Or over the maturity period of the instrument. Okay, so what we do is this one. Okay, equity is what? Equity is an asset or a liability? In the books of the issuer, equity, is it an asset or a liability? If the parent is issuing equity shares, it's a liability, isn't it?
The liability.
Okay, so what you do over here is that this particular one, so this issuing cost will be done like this. We are going to be debiting our equity shares, okay, because this debit should have been done to profit or loss, but we are not doing that. So we debit our equity and we credit cash because we are going to be paying cash over here. What I'm trying to say is that if there's any issuing cost arising from the issuing of the equity shares, that particular issuing cost will be subtracted from what? From the equity shares or from the equity value. What do we mean? Equity is a liability. So if you are debiting a cost to equity, it means that you are reducing the equity. So what we do is that the issuing cost over here will be subtracted from what? From the equity value. Issuing cost is treated like what? Issuing or transaction cost under financial instruments. Okay, so if the parent incur an issuing cost as a result of issuing its own security, that particular issuing cost will be treated as what? As transaction cost under financial instrument, which will be capitalized. Capitalizing meaning that it will be subtracted from the equity. Even if it's a preference shares, the same treatment, because they are all going to be a liability, because equity we are issuing, that is not value to the entity. Okay, if you're using a business entity concept, equity is treated as a liability. So equity is having a credit balance. So if you are debiting the issuing cost now, it means that you're going to be reducing. So you subtract it. Okay. You can also incur other costs. Okay. The only cost that should be capitalized in line with what business combination is the what? Is the cost of issuing own security, is the cost of issuing what? Is the cost that the buyer or the acquirer will be incurred by issuing its own security. That will be the only cost that will be accounted for in line with what financial instrument, which is the 32 and then the 20 and then the 9. But any other cost, okay, they will be telling you any other cost, which is going to be professional. So there can be professional fees, or the question you can say any related acquisition cost. Any other cost aside what? Any other cost aside any other cost aside the cost of issuing each own security. They can say consultancy fee, due diligence fee, any of them. Any other cost that is going to be aside the cost of issuing should be taken into profit or loss, should be expensed. Any other cost should be expensed. Any other cost should be what? Should be expensed. Any other cost should be expensed. The professional fees is not what? It's not the issuing cost. It's not the cost that you are paying to the agent of what? Getting a buyer for you. No. The cost that you are going to be paying to the agent, the brokers to get a buyer for you are all included in the what? In the issuing cost. So if you are talking about professional fee over here, it can be the consultancy fee. Okay. It can be the consultancy fee. It can be a consultancy fee and whatever fee. It can be a due diligence fee, any other fee. Okay. Any other fee that you are going to be incurring over here are going to be expensed. Why? Because these costs you will still incur them whether you go ahead with the what? With the acquisition or not, it will still be incurred. Okay. But this is not asset. If they should be asset, then we say that these are part of the cost necessary to bring the asset what? Ready, or to make the asset ready for what? Ready for use. So this will be capitalized if it should be an asset. But if you count to liability, these are not what? Incremental costs. These are costs that you are going to be incurring whether you go ahead with what? With the acquisition or not. Due diligence means that you are going to be carrying out what? Investigation on a subsidiary before you purchase. You have paid that particular cost already. After the investigation, you can decide not to what? You can decide not to buy. That particular cost has already been incurred. So any other cost, any other acquisition cost relating to what? Relating to acquisition that is not a cost of issuing your own security, that particular cost should be expensed. Okay, so you can see professional cost or consultancy fee, due diligence fee, and they can mention other ones, or they will just say acquisition related cost. If it is not the cost of issuing your own security, it should be taken to profit or loss. It should be taken to profit or loss because they are not incremental costs. They are costs that you are going to be incurring anyways if the acquisition is done or not. Okay, so they are not incremental costs. You are going to be expensing them. Okay, let me talk about other form of consideration. Then we pick the intra-group transaction and the necessary workings that you have to be doing. So we try to see what we can do within the next 1 hour. Okay. Another one is we say the share exchange. For now, we have done 4. Okay. So most of us, the one that we know is the 4. Share exchange, deferred consideration, contingent, and the what? And then the cash. No. We can also do we can also do the acquisition by transferring what? Assets. We can say that we don't have money, but what will happen is that we give you an asset. Okay. So there can be a transfer of PPE. There can also be issuing of what? Preference shares, loan notes. Okay, so we are going to be combining all of them in one and pick some example on it and move on. Okay, so what will happen is that there can be a transfer of PPE. Okay, there can be a transfer of PPE in settlement of that. Okay, if I want to buy plants, I don't have money, but I have land. I can use the land to pay for the plants. Yeah, so we can also do the acquisition like that. The consideration can be settled through transfer of PPE. How do we account for it? We are going to be looking at that. There can also be issue issuing of, okay, let me say issuing of loan notes, or let me say issuing of debt instruments. Okay, so issuing of debt instruments so that we can have the loan notes and also the preference shares over there. So they can issue preference shares, they can also issue loan notes to settle this particular consideration. So how do we account for all of them? If the question say that they have not been accounted for. Let's count to PP. Okay. This PP is going to be seen as what you have sold the PP to use the money to purchase the equity share with it, or the equity shares of the subsidiary. Okay, let's come here. If the question will give you the carrying value of the PP, so let's say the carrying value is 150. Okay, they will give you a carrying value of the PP to be 150 million. Okay, and they will give you the market value, which is the fair value, okay, of the PP to be what? To be, let's say 180 million. Okay, so they will say that in settlement of the consideration, the entity has transferred a land at a value of 150 million, which has a carrying value of 150 million, to which has a carrying value of 150 million and a fair value of 180 million to the former shareholders of the subsidiary. Okay, how do we account for this? Okay, the question will be telling you that the entity has only transferred, or they has only credited the PP with 150 million and debit consideration, or debit investment with 150 million. So what they will do is that we are using 150 million to pay for it. So they'll just remove 150 from the PP and debit investment with 150. No, that is not correct. Okay, the value is not 150. If you are selling the PP, how much are you going to be selling it?
180.
You are going to be selling this at 180, isn't it? Okay.
Yeah.
And you'll be having a profit on the sale of what? 30, isn't it? Okay. So if you are selling this, you'll be having cash. Okay, you'll be having cash of 180 million. What will happen? You have sold the asset, so you have to reorganize the asset. You have to remove it from your books. So you go to your PP and credit the PP with what? With 115 million. Then you credit profit or loss with a gain of what? With a gain of 30 million, isn't it? Okay. This cash that you are receiving, what are you going to be using the cash? You'll be using the cash to pay for what? To pay for the shares that you are buying, isn't it? Okay. So if you are using the cash to pay for the shares that you are buying, you'll be having debit investment of 180 million. Then you credit the cash again with 180 million. You can see that the cash and the cash over here is having a zero effect. Okay, what am I trying to say? The transfer should always be done at fair value. We assume that we are selling the asset and using the money to what? To finance the acquisition of what? Of the equity shares of the subsidiary. So we receive the cash, we recognize a gain of what? 30 million on that. Then we now go and use the cash to pay for the shares that we are buying. Okay. So the question will tell you that the only entry that has been done is what? They made a transfer of PP 150 to what? To investment. No. The transfer should have been done at 180. So this is what you are going to be doing. You are going to be increasing your investment. Okay, you are going to be increasing your investment. The investment should have been 180, but they have only 150. You go and increase the investment of 30 million. Then you come here and what? Credit profit or loss with a gain, or the group return earnings, depending on which statement that you are doing with 30 million. So you come and pass this entry. Okay, because they have passed only 150, 150. The entry should have been credit cash of 180 and debit investment. And we should have what? Profit or loss. Okay, we should have profit or loss of 30 million, but they have only 150, 150. So it means that the transfer should be done at fair value. So you go and increase your investment by what? By 30 million, which is the difference between the carrying value and then the fair value. And you recognize a profit or a loss on that particular arrangement. I have a question here. let's pick that one and demonstrate how we can go about this. Okay. The number 2A. Okay, the number 2A. We have on 1st June 2018, who acquired 80% equity interest of Wakrachi when Krachi's retained earnings balance was 113 million. The purchase and sale agreement provided that the shares should be settled as follows. Immediate transfer of a parcel of land. Immediate transfer of a parcel of land with carrying and fair value of 17 million and 20 million respectively, who has only debited investment in shares and credited property, plant, and equipment with a carrying value of the land. Okay, so what they are saying over here is that they have transferred 17 million from PP to what? To the investment. Okay, but what should have been the value of the investment? How much are we paying for the shares? How much are they paying for the shares in terms of transferring the land? How much should be the value? Is this should be 17 million or 20 million?
20 million
So what are we going to be doing now?
would be increasing it by the difference of 3 million.
Okay, so we are going to be adding 3 million to the investment because the investment should have been, we are giving them 20 million. Okay, the land will be given to them at fair value. Okay, we are going to sell the land and use the value to finance the acquisition. So we are going to be paying 20 million. So the investment is supposed to be 20 million. So we go and debit the investment to be 20 million. Okay. Okay. If the investment will now be 3 million, okay, what will be the corresponding one?
Since it's a gain on the land, we credit P&L.
Okay, please don't say that you are revaluing the land before you sell. No, you are selling the land. Okay. The land is assumed to be at cost model. So you are selling the land. So the gain over here is a profit or loss. Okay, it's a retained earnings or it's a profit or loss item. Just as soon as you are selling it to finance that one now. So you debit your investment to now make it 20 million. Then a land that is 17 million, you are selling it for 20 million. You are having a profit or loss of 3 million. So if you are doing statement of financial position, you are going to be adding this to the group retained earnings of what? Of the parent. But if you are doing statement of profit or loss, this will now be done at this will now be added or other income. You can include it in your other income or profit on disposal of land, and then you have your gain over there. Okay, let's come to the issuing of debt instruments, which can be preference shares or loan notes. It can be any of them. The question will tell you how the issuance will be done, how they are going to be issuing this particular amount. So I have two different questions over here, which we are going to be looking at. So let's come to this one. Okay, let's come to this one, and we'll be coming to this one. Okay, we'll be coming to this particular one. Okay, so they can sometimes issue loan notes. They will tell you how the loan notes will be issued. So we are going to be using these two examples to look at that. We are going to be using these two examples to look at that. Okay. The parent is buying 600 million of the equity shares. So the consideration is made up of the share exchange. We have done that already. And we have that a deferred consideration already. You can have a purchase consideration that you can have at least 3 ways of doing it. So you have to do all of them and add them together to know the total amount that you are paying for the shares. Okay, so we are going to be having this particular one. So they are buying 600 million of the shares, and they are saying that the purchase consideration was made up of share exchange. We have done that already. The fair consideration, we have done that already. The issue of what? 100 Ghana cedis loan note for every 500 shares acquired. Okay, this is a very simple issue. So for every 500 shares that we acquired, how much will be every 500 shares that we acquired is valued at what?
100 cedis.
Okay, so this is for simple ratio and proportion. 100 cedis will be equal to 500 what? Shares, isn't it? Okay. Okay, so 6 million shares that we are buying will be equal to what? How much? Okay, So for every 500 shares that you have acquired, it's valued at 500 Ghana cedis. Okay. So if 100 cedis is equal to 500 shares, 6 million will be equal to how much? Because we are buying 6 million. Okay. So you just ask yourself, how many 500 that you can get from what? 6 million? Then you multiply by 100. Okay. So this one doing a small ratio and proportion, this is what we are going to be having. So we are going to be having 100 Ghana cedis multiplied by 600 million
600
divided
million.
by 500 million. What are we having?
It's 120.
120.
Okay, 120 million. Okay, so that will be the the loan note that we are going to be giving to them. So we give them a loan note that will be valued at what? 120 million. So this is just a small ratio and proportion. Okay, so they will give you that they are issuing two for, they can say two for every 5 shares that they are buying. The same thing, 2/5 multiplied by the number of shares that they are buying, multiplied by the value of the loan notes. Okay, so they can say the issue of 100 Ghana cedis 10% loan note for every 500 shares acquired. So for every 500 shares that we acquired, we are giving them what? 100 Ghana cedis. So we have acquired 6 million shares. Okay, how many? Okay, if we want to group it, so how many groupings can we have for 500 shares out of what? 600 million. That's what we are saying. So we do a small ratio and proportion and what? And get your answer. That will be 120. This is a loan note. At the end of the year, what will happen? Okay, so let me pass the entry for that. If that has not been recorded, this is what we do. If that has not been recorded, you debit your investment because that is, you are paying that particular amount for what? For the shares. Then you credit your loan note, which will be a liability, a non-current liability at what? 120. At the end of the year, what will happen?
Shared finance cost.
We are going to be paying interest. These people are
Yes, finance.
These people are what? Are loan note holders, and they are going to be paying what? So you are telling them that they should be part of your what? Your creditors now. Okay. So, or someone can say that the entity will issue a 120 loan note and use the what? The 120 to what? To pay for the shares. Okay. People that you are issuing the loan note to, you are going to be paying them interest. So someone can say that this will be debit cash and credit the loan note, but the cash will now be used to purchase what? The equity share. So we now debit investment and credit cash. Cash is having a zero effect. That's why we are having debit investment, credit loan notes. If you issue loan note to people, you are going to pay interest. But at the end of the year, they are going to be paying interest. That will be treated as a finance cost, and that will be 0.1 multiplied by 120 if it is a full year, and that will give us what? 12 million. Okay, so they will be paying the loan notes. If they say this has not been recognized, they will pay the loan notes. Okay, so they will recognize the loan notes. If they say the loan note has not been recognized, it means that no entry concerning the loan note has been recognized. So the loan note is not in their books. Since it is not in their books, there's no way interest will be paid. But if they say the loan note has already been recognized, it means that it's part of the investment already. So we don't do this entry again. It is not in their books, so we don't do anything again. But if they say it has not been recognized, it means that the loan note is not in their books and the interest has also not been paid. So we will do the correct one. We recognize the loan note, we charge the interest. But since the interest has not been paid, the 12 million, you either take it from cash to assume that they have paid it immediately, or you now add it to the liability, meaning that they are here to pay the loan, the interest on the loan note. Okay, whatever be the case, it should be able to go about that particular one also. So let me come here to the B part here. Okay, B part, let's talk about what? The preference shares. We said that acquisition, there's 2 issues for the preference shares. The parent can settle the consideration through the issue of preference shares. That particular one, they are issuing the shares and use the money to pay the equity shares. That will be recorded. But the parent is what? The parent is buying the preference shares in addition to the equity shares. Their treatment is different. So I can be buying your equity shares and I'll buy preference shares in addition, or I'll buy loan notes in addition. That's a different issue. Okay, but I can be buying your shares, but I will pay by giving you what? Preference shares. In that case, I'm giving you preference shares for the acquisition. So I will account for the preference shares as a liability. But if me, I'm buying the preference shares from you, the treatment is different. So we are going to be looking at intra-group transactions where this particular portion will also be part of it. So let's come to immediate issue of what 75 million of a whole 15% cumulative what redeemable preference shares issued at what 2.5 per share. Who has not recorded this constitution? No preference dividend has been paid by who as at 31 May 2011. They say this has not been recognized. Assuming we are issuing these particular preference shares to outsiders, how much are we going to be receiving from this particular issue? How much are we going to be receiving from it? We are issuing 75 million preference shares at a value of what 2.5. So what will be the total amount of money that they are going to be receiving from this?
187.5.
187.5.
87.5.
Okay, 187.5. Okay. So assuming we are issuing these to what? To outsiders, it will be debit cash of what? 187.5, isn't it? And we credit preference shares of what? Of 187.5, isn't it? Why are we issuing the shares? We are issuing the shares to pay for what? For the what? For the acquisition. Okay.
Yes,
So this will now be, we now use the cash to pay. So using the cash to pay, this is what you are going to be having. Okay. So you now debit your investments because you are now going to be buying. So you now debit your investment of 187.5. Then you credit your cash of what? 187.5. Do you agree with that? Okay. Cash is having a zero effect. Okay, cash is having a zero effect over here. So the entry that you are going to be passing for this is debit investment. Okay, debit investment of 187.5, and you credit your preference shares. Okay, this is not investment in the preference shares of the subsidiary. The parent is the parent is the one issuing the preference shares. So they are paying for the shares through what preference shares. This is how they are going to be doing. They say no preference share dividend has been paid. If preference share dividend should be paid, redeemable preference shares are treated as what? As a financial liability. They are treated as a liability under financial instrument. So the dividend will be treated as what? As a profit or loss item. But they say no entry has been or no dividend has been paid. So you add 187 to your purchase consideration, which is part of the investment. Then you now have preference shares of 187.5 in the statement of financial position for this particular one, this particular company. Okay, so these are forms of the consideration. Let's look at how we go about certain issues. Okay, we are saying that the parent is going to be paying a certain amount of money, which can be in kind or in cash, for the shares that they are buying or for the asset that they are buying. Okay, let's come here. Let's assume that the total amount that the parent is paying, or the purchase consideration, the total amount that they are paying is what? Is, let's say, 800 million. Okay, they are not buying all the shares, so they are buying only 80% of the net asset of what? Of the subsidiary. Okay, what we have to ask ourselves is that, okay, how much should have been paid for what the parent is buying? Okay, how much should have been paid for what the parent is buying? You are not buying the full company. You are buying what? You are buying 80% of the what? Of the asset of the company. Okay, this 80%, all things being equal, how much should have been paid for this particular one? Okay, so we say that the portion of the net assets that the parent is buying at acquisition, you are paying this particular one 800 million at, let's say, July 1. What is the value of the portion of the company that you are buying at that particular date? Let's assume that this is now what? This is now 750. Okay, are we paying? We are buying an asset that will cost 750, but we are paying what? 800 million. What is happening there?
We are overpaying
Okay, we are overpaying by how much?
50 million.
Okay, this 50 million that the parent is paying, it doesn't mean that the parent is paying because they don't know what they are doing. No, they know what they are doing. Okay, because in the business, in the acquisition, they are going to be employing people to advise them how much they should pay. it means that they are aware. The 50 million that they are paying over here, they are paying for something that the subsidiary is not taking note of. So it can be for the location. They are compensating the subsidiary for the location. Okay, they have a very strategic location, so they are compensating them for the location, or they are compensating them for the relationship that they have with the customers, or they are compensating them for the skillful employees that they have. So this will always be termed as what? An intangible asset, which we call what? Goodwill. Okay, what are we trying to say? Okay, we are saying that at the date of acquisition, all assets should be valued at fair value. What are we saying? It's just like you are selling something. If you are selling something and the thing you have it, you bought it 10 Ghana cedis. Now in the market, 15 cedis. You cannot sell it at 10 Ghana cedis. You sell it for 15 cedis. That is why all the assets should be fair valued. Liability should be fair valued. Okay, at the acquisition date, you have to reconcile. Okay, you have to reconcile the amount that the parent is paying for the what? The portion of the net asset that they are paying. Okay, what do we do here? The parent is going to be having this. Okay, in the separate financial statement of the parent will be having investment in what? Investment in subsidiary, or let's say A, and that will be valued at what? 800 million. Okay, then you'll be having the value for what? For the subsidiary also as a net asset. Okay, what we do is that since we are consolidating, okay, the parent will not have the investment again. Okay, the parent will not have the investment again. Why? The parent investment will be written against what? The net asset of what? Of the subsidiary. That is why we don't bring the equity value of the subsidiary in the statement of financial position, because the equity value of the 750, which is at acquisition, has not been subtracted from what? The parent investment, and the remaining figure of the asset, that is what we call the what? The goodwill. So at acquisition date, the parent is paying 800 million, and the parent will have 800 million as what? As investment in 8 books. The parent is paying for 750, which will be included in the equity or the shareholders fund of the what? Of the subsidiary. So at the date of acquisition, we subtract or we net the equity against what? Against the investment, and we bring only the what? The difference, which will be the goodwill. Okay, so it is because of this reconciliation that we don't have the equity items of what? Of the subsidiary, because the equity items of the subsidiary has been reconciled against the parent investment recognized as an asset. We are canceling that. So the equity component will cancel that, and the remaining portion will be what we call the goodwill. Okay, before we can determine the goodwill, or before we can reconcile, we need to know how much the parent is paying, and we need to know the value of the items that the parent is paying for. Okay, so at the acquisition date, you need to reconcile the investment and then the net asset, and that will either give you a goodwill, or that will give you gain on bargain what? Purchase. So it can be a negative goodwill, which we call a gain on bargain purchase, any of them. Okay, how do we determine the goodwill? The goodwill is determined as what? We are just reconciling how much is the parent paying and how much should have been paid. Okay, how much is the parent paying and how much should have been paid. Okay, so our goodwill, okay, what I have calculated over here is this. Okay, you can do a lot of things. Let's come here. Let's come to this particular side. Okay, let's come to this particular side. So let me give you a very typical example, and then we can do that. Okay, let's assume that the parent is paying the same. Okay, the parent is paying the same 800 million. Okay, let's say that the net assets at the time that the parent is buying, okay, the parent is paying 800 million at a particular date, and the time that they are buying, the total net assets, okay, the shareholders fund, which we call the net asset, is what? Is 850. But the parent is buying a portion of it. Let's say the parent is buying 80%. And the question is telling you that the NCA value out of this is what? Is 100 million. Okay. The NCA is the portion that the parent is not buying. Okay. The NCA value is what? Is 100 million. What is the value of the net asset that the parent is buying? the total net asset, the total value of the shareholders fund is
850.
850. Okay. And they are saying that the portion that the parent is not buying is 100. This particular 850 is 100% what? Holding. The parent is buying 80%, and they are saying that the remaining 20% is 100 million. What is the portion that the parent will be buying?
That's 680.
No.
750.
7 and what?
50.
50. 850, don't come and do 80% on this. No. There's a time that we do 80%. There's time that we do 20%. They have given the value of the 20% already to be 100. Okay. So it means that the 850, which belongs to the total entity, the portion that the parent is not buying is 100. So it means that the remaining portion is the one that the parent is buying. So our net asset over here will be, our net asset over here will be 850 minus what? 100. And that will give us 750 to be what? To be the premium, the acquisition premium, which we call a goodwill. Okay. But what do we know? Okay. This particular goodwill can also be calculated like this. Look at this, please. We can have our purchase consideration. Okay. I'll be telling you how the NCI will be valid. So I can have 800 here. I can have my, okay. You can see that I'm subtracting the 100 from what? From the 850, isn't it? Okay. I can decide to bring all the 850. If I'm bringing all the 850, it means that the 100 is part of this one. So let me just add the 100 to this one. Okay. Then I'll now have my total net assets to be the 850 over here. Why am I doing this? Because I know that this is positive against negative. I'm going to be having 750. Okay. So what you can do is that if you want to use a total net asset, but what I do most is that I find the parent portion of it. How do I find the parent portion? What is the value of the company at the time that we are buying the company? I will just subtract the portion that is not for the parents. Then I'll get the portion that the parent is buying. Or you can add a portion that is not for the parent. You can add this one. Okay. You can add this one to this one. This is telling you 900 million. Okay. If the parent wants to buy the entity, the full amount, they're supposed to pay 900 million. For what amount? 850. They are going to be paying 50. That's what we call the goodwill. So you can add the NCI, then you bring all the 850. Why are you bringing all the 850? It means that the 100 should have been taken away from this. But since the 100 is included over here, add the 100 to that one so that they can have a zero effect. Okay. If you are owing me 850, if you're owing me 100 and you don't want to pay, I can also owe you 100 so that the two of us can just balance. So you have the 100 over there. The 100 that will also be owing you will be in the same amount, and that will cancel. So the goodwill, the calculation of the goodwill depends on what we are going to be doing. So let me show this. Let me show this. I will just show some of how do we determine the net asset. They will not give you that question. They will not give you the net asset straightforward. So you have to determine that. Okay, let's come to this particular situation. Assuming we are sharing the 850 based on the percentage holding, what would have been the values? Give me that one before we move on. Assuming we are sharing the 850 based on the value. The 850 is 100%. The parent is buying 850. NCI is taking 20%. What would have been the NCI portion?
170.
That would have been 170, isn't it?
Yes.
Okay. What I want to demonstrate, the 170 cannot do. So let me make this one to be 200. Okay. Let me make this one to be 200. So this will now be 650 here, isn't it? Okay. So this will be 650 and the goodwill will be 150, isn't it? Okay. So if we are sharing this will be 170, isn't it? Okay. This particular 170 should have been the portion of what? Should have been the portion of the NCI. Okay. The net asset that we have over here are the physical assets, are the tangible assets. Okay. And the NCI should be having 180. But how much are they having? 200, isn't it?
Yes.
Okay. What is that 30 coming from?
So that will be the portion of the goodwill.
Okay. So the 30 that is coming over here, the NCI is not that the parent doesn't know what they are doing. Okay. The NCI is now what? 200, but the NCA based on the what? Based on the physical assets should have been 170. Okay, the 30 that is coming over here means that the NCA is also having a share of the goodwill arising from what? From the acquisition. That will give you 30. Okay, and this will be the time that they will say the NCA is valued at fair value. And if the NCA is valued at fair value, that is why you have been sharing the goodwill impairment to the NCA and the parent. The meaning is that the NCA is also having 30%, 30 million of the goodwill. So if the goodwill is impairing, it means that their goodwill will also impaired. Okay, so if you have the NCA to be at fair value, it means that the value that the NCA should be having is not that one. So the NCA is having a share of the physical asset, which is a net asset of 20% plus the share of the goodwill. So any goodwill impairment that is arising, it means the NCA share of the goodwill will also be impairing. And that's why we share the what? The goodwill to the NCI. Okay. Whatever they are doing the NCI, whether it is proportionate method, whether it is a fair value method, the calculation of the goodwill is still the same. You get the same answer. Okay, you can find a proportionate method and you just add it. You get the same answer. Okay. So let me count to the goodwill over here. Okay, let me count to the goodwill calculation. You always have to reconcile. Okay, if you are reconciling, you'll be having a goodwill or gain or bargain purchase. So you have the purchase consideration, which can be determined through cash consideration or share exchange. They can give you so many ones. Okay, that will give you this one. So the one that you know, okay, you can add your NCA over here. Okay, just to be conversant with what you know. That is fine. So we have this one over here. Then you have your net asset at acquisition. Net asset at acquisition. So net asset at acquisition will now be net asset at acquisition. Will now be what? Will now be subtracted. Okay. Then you have the goodwill. Whether you are using proportionate method or whatever method, you'll be getting the same figure. So you can just find a proportionate and add it. You'll be getting the same figure. So you have the goodwill at acquisition. Goodwill at acquisition. They can give you some impairment of the goodwill. So the goodwill at reporting, you take the impairment out of it. Okay. Impairment, then you'll be having goodwill at reporting. Okay. At reporting. Then that will be taken to the profit or loss. Okay. So the impairment of the goodwill, like the example that we have over here. So the NCA is supposed to be 170, but they are having 200. Okay, it means that the NCA is having the share of the what? Of the intangible or the invisible item that we are having. So the NCA is also having 30. If there's any impairment, it means that the 30 of the share of the goodwill of the NCA will also impair. So the impairment will be shared among the what? So okay, I'll go to the NCA there. We look at the NCA. If the NCA is valued at fair value, the impairment of the goodwill will be shared among what? The parent and then the NCI. Okay, impairment is an expense. Okay, that will be shared among the parent and then the NCI. But if they say the NCA is valued at a proportionate method, where the NCA will just be the what? The percentage of their holding multiplied by the physical assets, which will be 170. It means that the NCA is not having any share of the what? The invisible what item. So this 70 is not including goodwill. So you cannot share the goodwill to the NCI. In that case, the goodwill will be given to the parent as a whole, because the parent is the one having the share of all the invisible items. NCA is not having portion of it because NCA is having only a share of the 850, which is the what? Which is the tangible asset, which is the visible asset that they are having, which is the asset in the books of the what? Of the subsidiary. Anything that is outside the NCA is not having portion of it. So any impairment, NCA will not be having any share of that. Okay. The question is, this particular net asset will not be given to you. Okay. They will not give you net asset. The question will not give you the net asset. You have to determine the net asset yourself. The net asset at acquisition, you have to determine that yourself. Okay. How do we determine the net asset? Please, the net asset in business combination is different from the net asset that we know under ratio what? Computation. Why? Okay. Why the net asset that we do under the net asset that we do under the what? Under the business combination, the calculation is different from the ratio calculation. Okay. Why? Do you know it's different? Do you know how we compute the net assets at net assets for business valuation as a business valuation? Business combination is different from how we calculate net asset for ratio analysis.
Yes, please.
Hello.
Yes, please.
So I know that in the ratio analysis, it is the total assets less the current liabilities.
Okay.
But in business valuation, it is the total assets minus your total liabilities.
Okay, I know, and I'm asking why.
I don't get the question.
Okay, I know that is how it is being
Because-
computed, but I'm asking why should the computation be different for the same item?
Because we have to consider the subsidiary.
Because we don't consider what?
We have to consider the subsidiary.
Okay, we have to consider the subsidiary. Okay, because it's early in the morning. Your voice, the sound of your voice is even telling that you are not sure of what you're saying. Okay, we have to consider the subsidiary. That is, I don't understand. Okay, so if you are, sometimes you are sure the way you talk, or yeah, the voice will sound like, okay. You see, for ratio computation, we are looking for a return on what? On investment. Okay, we are looking for the return on investment, and all the investments in the company over there will be the what? Will be the equity shares and the money that the investors, the lenders are bringing. But in this case, we are looking for what? We are looking for acquisition. We are looking for the portion that we are buying. Okay, this one we are buying to claim ownership. Business valuation or business combination, it is talking about ownership. Okay, so the debt holders are not part of the owners. So that the net asset is the what? Is the shareholders fund. We are looking for what we are going to be buying to give us what? Ownership. So we cannot include what? The long-term loan or the long-term liabilities in this particular calculation because it does not give ownership. They don't give what? They don't give ownership, okay? They don't give ownership. So we are looking for ownership over here. So this one should be the net asset. Okay, net asset. We are looking for ownership. What are we going to be buying to get ownership? Okay. I'm saying that this one will not be given to you in the question, but it will give you information to enable you to calculate that. Okay, let's come here. The net asset that we know over here, the net asset that we know under this one is going to be total assets. Okay, total assets minus what? Total what? Liabilities. Is that correct? Okay. Can we say that the net asset over here is the same as equity? Can we say that the net asset that we have over here is the same as equity? The net asset over here from the expression that we
Yes,
have
it
over
is.
here is the same as equity, isn't
Yeah.
it? Okay.
Yeah.
Yes, sir.
You can't use
Hello.
this part. Yeah, Senior.
Is it total asset of the subsidiary and then total liabilities of the subsidiary, or
The parent
Yes.
cannot acquire the parent. The parent cannot acquire itself. So we are talking about the one that we are acquiring. We are looking for a subsidiary.
Okay.
All right.
okay?
So we can say that this is what? This is equity. Okay. What we are having over here is equity. Please, you cannot use the total asset my total liability to determine the net asset. Why? Because they will not give you the asset value at acquisition. They will only give you the asset value at reporting. And included in the asset value, you don't know the portion that is what? That is there at acquisition. You don't know the portion that is there at what? At reporting. They can purchase additional what? Additional asset during the year. So we don't use the total asset. We don't use the assets and the liability to determine that. Okay. So if you want to determine your net asset, we use the equity method. What do we call the equity method? The question will always give you information on only the equity items. So we know that our net asset over here, our net asset over here is the same as the shareholders what? The shareholders fund. Okay. So what we do is that we use the equity side of it. Okay, we cannot say the asset. They will not give you the asset values and then the liability values at the acquisition date. Okay, but they will give you information on the what? On the net assets. Okay, the net asset at acquisition is the same as what the total asset minus total liabilities, because the total asset minus total liabilities will give us the equity. Okay, so they will give you information on the share capital. They will give you information on the share capital. Okay, they will give you information on the share capital. Or let me just talk about what are the components of the shareholders fund. We have the share capital itself. We have retained earnings. Okay, we have retained earnings. We have what? The revaluation reserve or other components of equity. Revaluation reserve or other components of equity. And we also have the share premium. Okay, we also have the share premium. And we can have other items. So if there was no changes, okay, if there was no changes in the value of the asset, we can say that our value at this particular date, the share capital, the retained earnings, the revaluation reserve, if we are given these ones, if we put all of them together, that will give us the net asset at acquisition. Okay, so what you do is that your net asset at acquisition, you have your share capital. Okay, the share capital at reporting will still be the same. The share capital at reporting will still be the same as the share capital at acquisition. Why? There will not be any new issue of shares, because we are saying that the parent will maintain the same percentage, the same control, 75. So if they are issuing new shares now, you see that there will be a dilution in the ownership of the parent. If the people are having 100 million shares and the parent is having 70%, if they have issued a new shares of 50 million, that will now give us what? 150 million. The parent will no longer be having 75. We want the control to be what? To be constant, 75% throughout. So we assume that there will not be any new issue of shares, because if there's new issue of shares, there will be a dilution of the ownership. So the ownership will still be constant. So there will not be any new issue of shares. Therefore, the share value or the share capital of the subsidiary at acquisition is the same as the one at reporting, because no new issue of what? Of shares. Okay. Then they will give you retained earnings at acquisition. Okay. They will give you retained earnings at acquisition. And the retained earnings will come over here. Put all of them together. Then you have the book value. So they can give you other components of equity or revaluation reserve. Any of them. Other components of equity. Put all of them at acquisition there. Then let's say we have share premium. You cannot have all of them. Okay. So you have share premium. So if you put all of these things together, that is what we are having for the net assets. So let me come here. Assuming I have my non-current assets, my non-current assets will be, let's say, 10 million. Okay. And I have my current assets. My current asset to be, let's say, 20 million. No, current asset should not be 20 million. So that should be, let's say, 5 million. I have my current liabilities. Current liabilities to be, let's say, 3 million. And I have my non-current liabilities. I have my non-current liabilities to be, let's say, 7 million. Okay. And I have my share capital. Share capital to be, let's say, okay, share capital to be, let's say, 4 million. Okay. And I have my retained earnings. So let me say share capital is 3 million, or the share capital is 2 million. My retained earnings is 2 million. My revaluation reserve is what? Is 1 million. Okay. Let's find the net asset from this particular one. What will be the net asset from this particular one that we have over here? What will be the net asset from this information that we have? The net asset is what?
5 million.
Okay, 5 million, isn't it? So that
5
will be
million, yeah.
the total asset minus total liabilities, isn't it?
Yes, sir.
Okay. Can we also find our net asset from this particular perspective? We know that net asset is just a
Yes,
shareholders
please.
fund. So we can just add this one.
That's
isn't
also
it?
5 million.
Okay. Let's come here. This is the net asset based on the book value. This is a net asset based on the book value. Okay. Let's say that they are saying that okay, a property or a plant with a carrying value of what? Of let's say a plant with a carrying value of 5 million. At acquisition has a fair value of 7 million. Okay. So they say that a plant with a carrying value of 7 million, with a carrying value of 5 million has a fair value of what? Of 7 million. Okay. The net asset that we have calculated over here, the value of the plant we included is the value of the plant that we included in the non-current asset over here. Is it the fair value or the carrying value?
The
There's
carrying
a
value.
carrying.
The
The
carrying
carrying
value.
value.
Okay. But the value is supposed to be 7 million, isn't it?
Yes.
Okay.
Yes.
So what it means that we have to come and add the 2 million over here because the 5 million is already here, isn't it?
Yes.
Okay. What would be our net assets now?
That will be 7 million.
7 million. Okay. You can see that the liability is still constant, isn't it? Okay. The liability is still what? Constant. So what will happen is that if the asset is increasing, we know that our accounting equation is like this: equity is equal to asset minus liability. So if the asset is increasing, the effect on the accounting equation will be the what? The equity will also be increasing because the liability is what? Is constant. Okay. So any fair value, so at acquisition date over here, any fair value which is an adjustment, so fair value adjustment or upwards. So let me just say upwards what? Upwards fair value. So we can add a 2 million to this one and have 7 million as well. So upwards adjustment as a result of fair value in the assets. Okay. You will be increasing your net assets. Okay. What if they are saying that the asset with a carrying value of 7 million had a fair value of what? 5 million. So the carrying value is what? And this is fair value. Okay. So what do we do over here? Do we add or we subtract?
We subtract.
Subtract.
Okay. So if we subtract over here, what will happen? Our net asset will now reduce to 3 million, isn't it?
3 million. Yes.
Okay. So we can also do 3 million over here, and this will be subtracted from this particular one. Okay. So let's just summarize everything because the time that I have is not enough. Okay. So let's come to if there's any downwards adjustment to the assets. If there's any downwards adjustment to the assets, which is fair value, that will be taken away from what? From our net asset table. Okay, this is also at acquisition. I'll bring you why we do the reporting. I'll bring you that one as reporting. Okay. So we have this one will be this one. Okay. Sometimes the asset can be a depreciable item. So the plant that we mentioned. So the question can tell you that the plant the plant had a carrying value of 5 million. Then they have carrying value of 5 million, and they are now having a fair value of 7 million. And the question will tell you that the plant has a remaining useful life of 4 years at acquisition date. Okay. And the question will tell you that the subsidiary has not incorporated this fair value adjustment in its books. Okay. If the fair value has not been incorporated in the books of the subsidiary, it means that they are still depreciating the asset based on what?
The cost.
Based on the cost, isn't it? Okay.
Yes,
They are
please.
saying that the fair value adjustment has not been incorporated into the financial statement of the subsidiary. What it means is that the subsidiary is still depreciating the asset as 5 million over 4 years, isn't it?
Yes, please.
Okay. But if we are incorporating the fair value now, it means that at the date of acquisition, the value of the asset should not be 5 million. It should be 7 million, isn't it?
Yes, please.
The depreciation from that date would have been 7 million divided by 4. Are we okay?
Yes, sir.
Okay. So if we are now incorporating the fair value of 7 million, it means that depreciation should have been charged on 7 million. But they charge the depreciation on only what?
Mhm.
Okay, so it means that they haven't charged depreciation on what value?
On 2 million.
On 2 million. So what you do is that you have to depreciate this one. Okay. The meaning is very simple. Okay. You are saying that the asset is having a value of 2 million at acquisition date. So let's say the acquisition date is January 2021. Okay. Reporting date is now 2021. Would the asset still be having the 2 million at the reporting date?
No, we would have depreciated.
It will have been depreciated. So that is the reason for depreciating the fair value. So if you are incorporating the fair value is incorporated at acquisition date, not reporting date. It is incorporated what? At acquisition date. So if it is incorporated at acquisition date, we are now reporting on what? On 31 December, a year now. So the value, which is 20 million at acquisition, cannot be 20 million again. We have used 1 year out of it. We have used 1 year out of it. So this particular 1 year that we have used out of it, the subsidiary has not taken the 2 million into consideration. Therefore, the depreciation has not been charged by them. Depreciation has not been charged by them. So let's come to the additional depreciation over here. Okay, the additional depreciation over here. Now this additional depreciation will be 2 million divided by 4. What are we having?
0.5.
0.5, isn't it? Okay. It
Yes.
means that this 0.5 or the value of the asset would have been 1.5 at the what? At the end of the year. So this 0.5 has not been taken into account. So let me come here. Let's come to this place. Okay. Retained earnings at acquisition is what? Is 2 million. Okay. Let's assume that the retained earnings at reporting is now 6 million. Okay. Retained earnings at reporting is now 6 million. What is going to cause a change in the retained earnings?
When there's addition, profit.
When there's a profit. Okay. It means that the profit for the year of the subsidiary is 4 million, isn't it? Okay.
Yes, please.
So this particular 4 million was a depreciation of 0.5 taken into consideration before getting the 4 million.
No, sir.
No. So what will happen? It means that the depreciation has to reduce what? The 4 million, which we call the post-acquisition adjustment. Okay. So this is the post-acquisition profit. We are taking the 0.5 million from it. Okay. There can be so many issues. Okay. But let's talk about this particular one. What would be if you come to the statement of financial position? We have adjusted that one. Okay. If you come to the statement of financial position, let me come here. Okay. So let's assume that the statement of financial position over here. Okay. Statement of financial position over here. What is going to happen is that the subsidiary will be having a PP of this. Okay. Let's say that they are having the 5 million. They will be reporting the 5 million. Okay. And that 5 million will be reported as 5 over 4. 5 over 4, what is the depreciation?
That's 1.25.
1.25. Okay. So what will be the PP that they will be having here? They will be having in the statement of financial position at the reporting date, they will be having 3.75, isn't it? Okay, 3.75. Is that correct? Okay.
Yes.
Let's come here. They are saying that the value of the asset has increased by 2 million, isn't it? The fair value is
Yes,
now
sir.
7 million. It has
Yes,
increased by
yes.
2 million. Okay. So it
Yes.
means that the asset, we have to come and increase it by 2 million. Do you agree to that?
Yes.
Okay. But
Yes, sir.
at the reporting date, would the value of the asset still be what? Would the value still be 2 million?
No.
No, it will be 1.5 because we have depreciated it by what? 0.5. So we come and subtract the 0.5 over here. Okay. Or someone can say that this is 3.75 plus what? 1.5. Do you agree?
Yes.
Okay.
Yes.
So if there is what? If there is upwards what? If there's upwards change in the value which has not been taken into consideration, and the item is a depreciable item. Okay, what we do is that you are going to be calculating additional depreciation. Okay, you are going to be calculating additional depreciation. Okay, because if the value is increasing, that particular value will be an increment, and that particular increment will also be used over the useful life of the asset. So you look at the fair value adjustment. Just calculate the depreciation on the fair value adjustment, because the depreciation was calculated on only the carrying value, which should have been 7 million. So it means that they didn't charge depreciation on 2 million. So just take your fair value adjustment, which is an increase, then you calculate the depreciation on it. If you calculate the depreciation, this is the entry that you are going to be doing. Okay. First of all, have your fair value adjustment. How do you go about the fair value adjustment? This is what you are going to be having. So you are going to be debiting your net asset. You are going to be debiting the asset first. Okay. You are going to be debiting the asset with an amount of what? With an amount of 2 million. Okay. This will also increase the net asset. It will increase the equity. So you credit the net asset. Crediting the net asset means that you add it to a net asset table. So you have your 2 million over here. This is the initial recognition. At the end of the year, what will happen is that the asset will be depreciated. So debit, profit or loss, or the net asset, because mostly the net asset, the profit will be under the net asset, which will be at the reporting date. So you debit the net asset, which is the reporting one, with a depreciation of 0.5 million. Then you will now credit the assets. Okay, you now credit the assets with 0.5 million. So in effect, you can see that you are adding, you can see that in effect, you are debiting the assets by 1.5, debiting profit or loss by 0.5, and you are crediting the net asset at acquisition of what? 2 million. Is that okay? Okay. So this particular one is very important for corporate reporting and financial reporting. We are going to be picking a question, then we look at that. But let me look at the downwards arrangement before we pick a tutorial question there. I cannot talk about the issue here. Okay, but I will try to consume additional 10 minutes. Let's see. Okay. Let's say that the carrying value at the reporting date was 7 million. Okay. And they are saying that the carrying value at acquisition was what? 7 million. They are saying that the fair value was what? Was 5 million. And the remaining useful life, let's see, at acquisition was what? 4 years. Okay. This one, if this has not been taken into consideration, if this particular one has not been taken into consideration, if this particular adjustment has not been taken into consideration, okay, it means that the subsidiary will be charging depreciation on which value?
That's 7 million.
Okay, subsidiary will be charging a depreciation. The depreciation charge for the year will be what? Will be 7 million divided by 4. What are we having?
$1.75.
Okay, 1.75. Okay, but the depreciation should have been charged on what?
5 million.
Okay,
5 million.
depreciation should have been charged on 5 million at acquisition. Which should have been what?
That's
1.25.
1.25.
Okay, so it means that this particular the subsidiary has overcharged depreciation of how much?
0.05.
Okay, so it means that they have overcharged the depreciation of what? They have charged over depreciation of on the 2 million, isn't it? They have overcharged
Yes.
depreciation on the 2 million. So what we do is that if you want to know the excess depreciation, we call this one excess depreciation. The asset at acquisition was 5 million, not 7 million. But they are still what? Charging the depreciation on what? On 7 million, not what? 5 million. So the depreciation should have been 1.25 because the asset at acquisition is what, 5 million, because we have reduced the asset now to what, 5 million. We are taking the 2 million from the net asset at acquisition. So it means that we have reduced the value of the net asset or the value of the asset to 5 million. But you are still carrying it as 7 million in your books. That is wrong. So what we do is that we call something excess depreciation. We look for the depreciation or the overcharge depreciation, which will be just the what, the excess amount or the fair value over the remaining useful life. But because the depreciation should have been charged on 5 million, they charge it on 7 million. That means that they have done 5 million over 4 plus 2 million over 4. Do you agree? So we now come and take what, the 2 million portion. Okay, and that will give us what, 0.5 million. Okay, so the depreciation, if our retained earnings or if our profit for the year, okay, using the same figure, if our profit for the year was 4 million, the depreciation that was taken before getting this 4 million was what? 1.75, isn't it?
Yes, please.
So what do? We now come and neutralize that one by adding what?
0.5.
As excess depreciation, isn't it? Okay. Okay. This particular profit for the year will be under reporting because the difference between the opening retained earnings and the closing retained earnings is what? Is the profit. So the excess depreciation is having effect on what? On the profit. The excess depreciation is having effect on the profit. So what we do is that we go and add it to the profit. The profit will be under the net asset table. Okay. For me, I don't really do the net asset table. I only do the acquisition. I'll do it when I'm calculating goodwill. Okay. Then the profit for the year, what I will do is that I will just bring the profit for the year and adjust it with what? With the figures that should have been added or that should have been subtracted from the what? From the profit before getting whatever, then I will just share. But we are going to be doing the two. You pick the one that you like. Okay. So we know that certain transactions that will happen during the post-acquisition period, but that has not been adjusted. So because the profit that we have over there, the profit for the subsidiary has not taken into consideration those post-adjustments. So I have to come and adjust it. Those that will be increasing the profit, I'll add. Those that will be reducing, I will subtract. Then I will get my profit. I will share between the NCI and then the parents. Okay, let's come here. What will be the entry that we are going to be passing on the assets? The statement of financial position for the entity will now be having a PPE. Okay, this particular PPE they will be having they will be having 7 million. Okay, because they have not taken that into consideration, their PPE will be including 7 million minus what? 1.75. Is that correct?
Yes, sir.
Okay, but this in actual sense should have been what? Should have been 5 million minus what? 1.25, which will give us 3.75, isn't it?
Yes, sir.
Okay, what will be the value there? 7 minus that one, what are they having? 7 minus 1.75. They're having 5.25, isn't it?
Yes, please.
Okay, what is the difference between these two?
That's 1.5.
That's 1.5, isn't it? Okay,
Yes, please.
let's come here. You see, we know that the loss is what? The loss on the revaluation was what? Was 2 million, isn't it?
Yes, please.
Okay, but we have consumed what? 0.5 to profit or loss for the year. Remaining will be 1.5, isn't it?
Yes, please.
Okay, so this is what you do it. So what you do over here is this one. You can either add you can either come and subtract the 1.5 over here to have your figure, or you come here. Okay, you come here. What will happen is that we are going to be subtracting. If we are doing the adjustment, then it means that we have to take what? 2 million from what? From this particular figure. We're supposed to take 2 million from this particular figure. Okay, but this figure is not added, it's not what? It's not provided at what? At cost. Okay, if you are taking the 2 million from here, it means that depreciation should have been zero. Depreciation would have been 1.25 here. If you are taking 2 million from this one, that will give us 5 million, isn't it?
Yes, please.
Then the depreciation should have been 1.25. Okay, depreciation should have been 1.25 because at 5 million, depreciation is 1.25. But the depreciation that was taken over here is 1.75. So if you are taking the 2 million, you are reducing it to 5 million. But the depreciation that was subtracted was what? 1.75 instead of what? 1.25. You have over subtracted the depreciation. Then you come and add your 0.5 over here. Okay. So if you have the entry like this, you debit your net assets at acquisition. That is the initial issue. So you debit your net asset at acquisition. That will be 2 million. Okay. You credit your asset at acquisition, also 2 million. At reporting, this is what you do. Okay. At reporting, this is a loss. Okay, this is an impairment loss that will be realized over what? Over 2 years. So what you do is that you will now debit, okay, what will happen is that we are crediting the asset 2 million. So in this particular one, you debit the assets. Okay, you debit the asset with 0.5 because you have over subtracted more than that, and you now credit what? Your net asset at reporting with 0.5. Okay, that's how you go about it. Okay, because the depreciation, you have over subtracted the depreciation. The depreciation was charged on 7 million instead of what? Instead of 5 million. So in the books of the subsidiary, they will still be having a value at 7 million less the depreciation that has been charged. So if you are reducing it by 2 million, it means that the depreciation should have been 1.25, but you have subtracted 1.75. You have subtracted in excess. Come and add the 0.5 so that you can reduce this one to 1.5 now. Okay, that is how we go about this one. So the fair value adjustments, whether increase or decrease, can be bringing an issue of additional depreciation if the item is what? Is a depreciable item. Sometimes also the fair value adjustment can bring issues of deferred tax. Okay, although we are here to do income tax, which we'll do on Monday. Okay, what will happen is that we say that deferred tax is calculated, or temporary difference is calculated as a carrying value against what? The tax base, isn't it? Okay. What it means is that at acquisition, what it means is that the tax base and then the carrying value are the same. So if the asset is 5 million and if the carrying value of the asset is 5 million, the tax base is also assumed to be 5 million. Okay. If you are now bringing the asset to a fair value of what? 7 million, what is happening? The carrying value will now be what? More than the tax base, because the tax authority does not do what we call revaluation. They carry the asset at cost less what? Less accumulated what? Capital allowances. So they will still carry the asset. The tax base will still be what? The tax base will still be what? 5 million. You can see that the fair value or the carrying value of the asset is now higher than the tax base by 2 million. In this case, it is the entity that is going to be enjoying, because they will be charging more of the what? More of the depreciation. Then the tax base will be giving them this one. So this will be creating what we call a taxable temporary difference, because the carrying value of the asset is higher than the what? Than the tax base. Or someone can also say this one is a revaluation surplus. Assuming you are paying tax on this, what are you going to be paying? So the entity will create a deferred tax for this one. Let's say 0.25 multiplied by this, and that will give us 0.5 million. Okay, so at acquisition, you bring a deferred tax liability. Okay, you bring a deferred tax liability of 0.5 as a reduction. Then maybe they will give you a certain information on this particular figure at the reporting date, because this is a depreciable item. Your temporal difference will be 1.5 at the end of the year, because you have depreciated the asset at the end of the year and you're having a difference of 1.5. Okay, then you charge the deferred tax liability on the 1.5 again. Then you'll now be getting that one. There will be a decrease on that particular, which will be a gain. Okay, we will pick a question and look at that. So I have to talk about whatever. Let me talk about all the necessary issues before I will come and talk about the intragroup trading. I cannot talk about that one now. Okay, but the fair value adjustments the liability can also be increasing or reducing. They can give you issue about contingent liability and other issues also there. So let me come to this place. Let's use some questions over here so that I can talk about the intra-group trading on Saturday. Then I'll share with the corporate reporting people. So let me come here to this one. Fair value adjustment, fair value adjustment. This is intra-group trading, intra-group trading, intra-group trading. Okay, let's look at question number 5, the example 5 there. Charles, are you there? Okay, I don't have Charles today. Vic, are you there?
Yes, please, please.
Okay, take the 5 for us so that we can now close.
Question 5. At acquisition date, sorry. At acquisition date, carrying value. Using my phone, sorry. Okay. At acquisition date, carrying value of Karachi net asset was equal to fair value except the following 2 items. A. The license had a fair value of 30 million cedis as compared to its carrying value of 20 million cedis. The remaining useful life is estimated at 5 years. The recoverable amount of the rights at 31st May 2011 was estimated at 22 million cedis. Karachi has not incorporated the fair values in its separate financial statement. Ignore the fair tax for this adjustment. B. An item of equipment with fair value of 12.5 million cedis in excess of its carrying value. It had a remaining useful life of 5 years. The fair value adjustment should be deemed as temporary difference with which fair tax rate of 20%.
Okay, so we will be doing the deferred tax for the 2. Okay, let's come here. Okay, please, what you have to know is that the net asset that you are going to be calculating, it will always be based on what? On the book values. Okay, so you calculate the net asset from the what? From the book values. Take the share capital, you take the retained earnings at acquisition, you take either other component of equity at acquisition. All those figures are based on book values. So we use a carrying value to calculate those ones. Okay, but since we are going to be selling the shares must be valued at fair value. So we bring all the assets to their fair value. Okay, they say that the license had a fair value of 30 million as compared to its carrying value of what? Of 20 million. The remaining useful life is estimated at what? 5 years. The recoverable amount of the rights at 31 May. So the reporting date is 31 May. Okay, was estimated at what? 22 million. Karachi has not incorporated the fair value in each what? Separate financial statements. Ignore the fair tax for this what? For this adjustment. So what will be the effect of this on the net asset at acquisition? Okay, net asset at acquisition. So let's look at the net asset at acquisition. So assuming we have our share capital, the retained earnings, all from the book value. Okay, are they saying that a liability is increasing over here, or is only the asset that is increasing? It's only the asset that is increasing, isn't it?
Yes, please.
Okay,
Trade assets.
so if the asset will increase by how much?
10 million.
Okay, so if the asset is increasing by 10 million, liability will be constant. That means that the net asset or the equity value will also be increasing by what? By
10 million.
10 million. So it's just like the effect on the accounting equation. If the asset is increasing, liability is constant. The other side of the accounting equation will what? Will be increasing. Okay, so we have what we call the 10 million will be increasing over here. We have 10 million as an increment over here. Okay, we are going to be doing, they say we should ignore the fair tax, but I will show you the deferred tax on this one. Okay. In the statement of the entity, they have amortized how much? How much has been amortized? The amortization was charged on which balance?
20 million.
20 million.
20 million.
So they have not taken this into consideration. It means that for the full year, this has not been taken into consideration. We assume that it's a full year acquisition. Okay. So they have amortized only 20 over what? Over 5.
Right.
And that will give us 4 million, isn't it?
Yes.
Okay. But amortization should have been on what?
30.
So it means
30.
that they haven't amortized what? 10 million, isn't it?
Yeah.
Okay. So you can just ignore all of this one because most of the time the question will not give you the carrying value and the fair value. So you just look at, okay, it means that the 10 million has not been amortized, or if we have 10 million at acquisition date, it will not be 10 million at reporting date again. So we'll be having 10 divided by 5. What are we having?
2.
2.
Okay.
2.
This 2 million has not been accounted for, isn't it?
Yes,
Yes.
please.
Okay. So this is supposed to reduce our profits. Okay. So if you are doing the net asset at both one, you count to amortization over here. The amortization will now be taken away from the net asset at acquisition because it is the net asset at reporting. You take it from net asset at reporting. Why? Because the profit for the year is at the net asset at what? At reporting. Because the difference between the two retained earnings will give you the profit for the year. Okay, so you can take your profit for the year separately and adjust these 2 million from it. Let's come to how this will be reported in their statement of financial position. Very necessary. Okay, in their statement of financial position, they are going to be having 20 minus 4. Is that correct?
Yeah. Yes.
Okay, because they have not incorporated the fair value adjustment in their book, so they will be having 20 minus 4. Is that correct?
Yes.
Okay, that 20 minus 4 will give us 16. Okay, but what's supposed to be the actual value of what? Of this particular one is supposed to be 30 over
30
5
minus 6.
multiplied by 4, isn't it?
Mhm.
That will give us what? So that will give us 24.
24.
Okay, that
24.
will give us 24. How do we do it? Very simple. What you do is that you first increase this one by 10 million because the fair value has increased. So the first entry is that you debit the Lancet, which is the asset, you credit the net asset. That is the initial recognition. So at the date of the acquisition, your net asset will increase and your asset will also increase. So you add a 10. At reporting, what will happen? The value of the 10 will reduce to what? To 8, isn't it? Okay.
Yeah.
So you come and take the 2 million from this. What will be the value that we are going to be having now? 24. Okay. But they are saying that the recoverable amount is what?
22.
What is happening there?
Impairment.
Payment.
So we come to this one and still take what? 2 million from the asset over here. Impairment is an expense, which is happening at the end of the year. So you come and take impairment loss from this one, from the profit again. Okay. So this is how you go about it. Initial recognition. You debit the asset because the value of the asset is increasing. You debit the asset with 10 million. You credit what? The net asset with what? With 10 million. At the end of the year, the license has been amortized. So you debit profit or loss with 2 million and you go and credit the asset with what? With 2 million. That's what you do. Okay. So you can follow the double entry principle if it is going to help you. Okay. But most of the times we just do the critical thinking. Asset will increase, this one will increase. Since the asset has been amortized, it means that we're supposed to add 8 million. So you can just find a difference of 8 million and go and add. And there's an impairment of what? 2 million. You go and subtract the 2 million also. Or you go and add 6 million to the asset. That is all. Because you have adjusted the impairment and also the amortization against that one. Okay. They say we should ignore the deferred tax issue there. Okay, I want to take the deferred tax issue on that one. But since we are going to be doing deferred tax adjustment for this one, then let me just use this one to explain the deferred tax issue. Okay, if I want to do this one, it will be too long for us. Okay, because the first one, the first value, okay, okay, let me just show this one also. Okay, this is just an example. Okay, and it's very important. Corporate reporting, you'll be seeing this adjustment. Forget about advanced issues. Okay, the advanced issues, It's just how you are going to prepare the financial statement. You can have a fair value adjustment, which will be giving you additional amortization or liability or whatever. Okay, let's come here. At acquisition date, we assume that the tax base and the carrying value are the same. So the tax base will be what?
With your mom or your sister
The
this week.
tax base will be 20 and the carrying value will also be 20. Okay. But at acquisition, what is happening now? Our carrying value has been revised to 30, isn't it?
Yes.
Okay. What is the difference there? 10 million, isn't it?
Yes.
Okay. If
Yes.
the carrying value is higher than the tax base, it's a taxable what? Temporary difference. What it means is that the tax authority is giving more capital allowance to the entity. So the entity is enjoying now. They will be suffering in the future. So we calculate a deferred tax liability over here. Deferred tax liability will be 0.25 multiplied by 10, which is the difference. And that will give us 2.5 million, isn't it? Okay.
Yes.
So at acquisition, you recognize a deferred tax liability of 2.5. You remove it from the net asset. This is a liability. It will be reducing the net asset. Okay. Let's come to at reporting now. Okay. At reporting, what will happen? At reporting, you see that the tax authority will be having 16 in each books, isn't it?
Yes, sir.
They will give the amortization. They will give capital allowance for the 5 years, so that will be 4 million. Okay, but the entity will be having 22. The entity will be having 22 of the carrying value. Is that correct?
Yes, sir.
Okay. What is the difference?
The difference is 6.
Okay. Or you can say that the 10 million, okay, this 10 million will be reducing by 2 million, will be reducing by 2 million. So the 10 million at reporting will now be having a value of what? 6 million. So what will happen? We now charge, oh, they say this one to be 2. Okay. The tax rate should be
Charge by
20%. Okay,
0.25.
so we have 2.0 here. Okay. So what will happen is that at acquisition, you do your deferred tax. At reporting to you still do the deferred tax. How do you do it? You just look at the remaining value of the excess amount. So it was 10 million, but this will not suffer amortization of 2 million, also impairment of 2 million. It is having 6 million. So you also charge the deferred tax on that one again. It means that the carrying value will be higher than the tax base by 6 million again. So you multiply this by 0.2. What are you having?
$1.2.
Okay. So at reporting, your deferred tax asset will be what? Will be 1.2. Why 1.2? Because you are going to be enjoying some benefit on what? On the 0.4, the 4 million loss. Okay. So you can see that there is a decrease in the deferred tax over there, which will be 0.8. So if you are doing only the profit, you come to the decrease in the deferred tax, which is going to be, again, it's a movement in deferred tax, which is a decrease. That will be 0.8 as a gain. So this is how we go about a deferred tax issue. You find it at acquisition, then you also find the value at reporting and also find that one. Then you put the two over there at acquisition and at reporting. The difference between them will be the movement in the deferred tax, which will be a gain to the entity because the deferred tax is reducing. Let's come to the B part. Then I will just end it over here. Saturday, I will do the intra-group trading. Then I will share the recording with you. Okay. An item of equipment with a fair value of 2.5 million in excess of its carrying value. It had a remaining useful life of 5 years. This value adjustment should be deemed as a temporary difference, which suffers tax rate of 20%. Okay. This is a kind of English that you are going to be saying. They will say the asset has a fair value of 2 million below its carrying value, in excess of its carrying value, above its carrying value. An item of equipment with a fair value of 12 million in excess of what? Its carrying value. If you come here, is it a fair value that is higher than the carrying value, or the carrying value is higher than the fair value, based on the English here?
The fair value is higher
Okay.
than the carrying value.
So net asset at acquisition, what do we do? We be We'll be
12.5.
increasing this one. We have what? Equipment over here. Okay. So that will be 12.5, isn't it?
Yes.
Okay.
Yes.
They are saying that this is subject to deferred tax. So we have a deferred tax liability here. Okay. We have a deferred tax liability here. Okay, we have a deferred tax liability here. The deferred tax liability will be 0.2 multiplied by just the fair value. Okay. The asset will be increasing by 2.5. Okay, the asset will be 2.5 more than the what? The tax base. What are we having?
2.5.
2.5.
Okay. Okay. So the entity was, the depreciation will be charged on the original value, which is the carrying value, isn't it? Okay.
Yes.
It means that depreciation has not been charged on what? On 2.5, on 12.5 rather. So we count to the additional depreciation of what? 12.5 divided by 5. What are we having?
2.5.
2.5.
Okay, 2.5. So the initial entry is debit the asset with 12.5. Then we credit the net asset, isn't it?
Yes.
Okay. The credit to the net asset will be only 10
Expect you
million.
to help me so much.
Do you agree that the credit to the net asset will be 10 million?
Yes.
And credit to deferred tax will be 2.5. You can see that we are
We
only adding
expected
10
it
million there.
angry, but she gave us a
Okay.
big
Okay. Let's come here. At the reporting day, what will happen? We debit profit or loss, isn't it?
Yes.
With 2.5. Then we credit the asset with what?
2.5.
Okay,
5.
2.5. Okay. We debit profit or loss with 2.5. Okay. This is what you are going to be doing again. Okay. The increase in the asset is 2.5, isn't it? 12.5
Yes, sir.
rather. Okay. But we have used 2.5 out of it. What will be left?
10 million.
10 million. So it means that the carrying value of the asset will now be higher than the tax base by only 10 million. So let's calculate the deferred tax on the 10 million now. What are we having? That will give us 2 million, isn't it? Would that be 2 million?
Yes, please.
Okay. But the deferred tax is what? Is 2.5. But now they are saying that it's 2 million. What do we do?
Find the
Deferred tax is
difference.
a liability. So we debit the deferred tax of what? 0.5 million. Is that correct?
Yes, sir.
Then you credit your profit or loss, which is a movement in deferred tax of 0.5 million. Okay, so that's what you do. So you come here, your deferred tax at reporting will be only 2 million. There is a movement of 0.5, which is going to be giving you what? A gain over there. Okay, that's a very simple exercise. So please, it's 6:21, and some of us we have work, and I have to talk about only the intra-group transaction. Okay, where they are going to be having trading issue, where they are going to be doing a transfer of assets, where there will be investment in loan notes and other ones. So those are the things I will talk about and bring a practical application or how you can solve the question in the exam hall. What are the things I should be putting there? But it is better you understand before you know what you are doing. All right. So this is all about it. Any issue? If there are no issues, we will continue because we don't have time, so we cannot
Everyone was
come.
delighted to meet the newest member of our family.
We cannot come Wednesday to do this again, okay? Because we don't have time. So I will continue with the financial reporting people on Saturday. That will be done. That will be the morning 9 a.m. But I will share the link on corporate reporting class so that those of you that you don't have case study, you can join so that we can solve questions and look at the intra-group transaction. But whatever be the case, I will share the video on the corporate reporting page. If you don't have any issue, I declare this meeting over. Okay. Thank you all for coming.